Welcome to the Traders Show. This episode is brought to you by Paperstone.
Hello traders, welcome back to another episode of the Traders Show. In this episode we're going to be talking about Black Swan events. So I was once reading the Market Wizards book, and there's this guy called William Eckert who said the unexpected will happen from time to time, and one should prepare for the unexpected happening. In that, there are things that will happen over your lifetime as a trader if you will be trading for long. Especially if you're trading for 1 year or 2, you may not experience some of these things, but if you'll be trading 10, 20, 30 years, you can trust me in your career. There will be some times whereby the unexpected things which you couldn't even think about will happen, and they'll affect prices in some extreme ways. So you need to be prepared for that. Today we are going to look at some of the black swans that have happened before. We're going to talk about how they affected markets and how you can prevent yourself from being caught up in some of these black swan events. Because in our short career, we've just traded for around 6 years. We've been looking at markets for around 6 years. And in that short career, we've already witnessed 2 black swan events. And they affected markets in adverse ways, in very, very severe ways. And today we are going to shed some more light on some of the things that happened before and what we think and how you can prevent yourself from that. So my name's Akian. I'll pass it on to my colleagues to introduce themselves before we kick off.
Hey guys, so welcome to today's podcast. As Ken has said, we'll talk about Black Swans events. As Ken has said, we've seen a couple of them happening in our trading career. And most of you are going to experience, because Black Swans, as Ken has said, the unexpected happens more often than not. So they'll come. That's a certainty. So we'll talk about a few of them today, so that you guys can get familiar with them and understand what Black Swans are and how you can prepare yourself in the future. So that's it from me. I'm Caleb, for those who do not know me, and I'm looking forward to sharing with you guys.
Okay, great. Greetings, traders. My name is Taras Lawi, and welcome again to another episode. So today, my colleagues have already introduced the topic. We're going to talk about black swans. So we'll make it in detail what are black swans, some events that we've witnessed, some historical events that have also happened before we started trading, because there have been a couple of them which happened before we started trading. We look at some ways of mitigating these risks, because previously, I think the past 2 episodes we talk about the different kinds of risks, and black swan is ideally just a form of risk. So it's we call it the black swan risk. So it's a form of risk, and we'll try to also look at how do you try and mitigate a risk that is very, very unpredictable. Markets are of course uncertain, but again, black swan risks double the uncertainty in the markets. So as you trade, you always have to know that you have to have some mitigation plans for how you will escape or avoid black swan risks happening, especially negative black swan risks, because most of them are usually negative consequences. Few of them have positive consequences, but a lot of them have very, very negative and deep consequences in the markets. So markets drop huge percentages. They drop, the standard deviation increases a lot in the markets, and cause a lot of portfolio how do I put it, the portfolio basically gets very, very big dips in the markets. So we'll try to look at how do you maybe safeguard yourself from losing very, very big chunks of your portfolio to black swan risks. Maybe 20, 30, 40% of your portfolio can easily go when you're faced with the black swan risk. So we also look at some ways to mitigate them, and hopefully it will help you guys as you take up your trading, also to understand that not all forms of risks are very, very predictable. So you need to understand that some forms of risks you can't foresee them, and you can't really prepare yourself well for them. So you have to also know how you'll handle that. So trading is very, very risky because of such things also happening. Apart from the risks that we can control, there are some risks that we really can't control 100%. So some things like now the black swan risk. So we'll try to put it in depth in this podcast. It will be a short podcast. We'll basically just highlight a few of them, the consequences they had in the markets, and basically how someone maybe would have protected themselves from the consequences of the black swan risks.
Paperstone gives you access into the global markets with more trading opportunities, first-class customer service, and peace of mind. Withdrawals are quick, and for those in Kenya, M-Pesa is enabled. Paperstone Markets Kenya is regulated by the Capital Markets Authority. To open an account with Paperstone and begin your trading, click the link on the description below.
Can you start with maybe the definition, then we can do the examples.
Okay. So to just define black swans, I think it's better if I rely on Investopedia, because it's defined black swan in the best way possible. So a black swan is an unpredictable event that is beyond what is normally expected of a situation and has potentially severe consequences. So just like we had said, thinking about the context of a black swan event, it's an unpredictable event. So when you're trading markets, there are some things which are quite predictable. For example, after extreme moves to the upside or extreme moves to the downside, mean reversion strategies will tend to rely on expecting markets to come back to the norm, and sometimes things will go back to the norm. But there are times whereby the unexpected will happen. In that, for example, just to give one example, is when oil went to zero, no one expected oil to go to zero. That just happened because it was a black swan event. And the fact that some of these things are unexpected makes them even go to the extreme cases. Because once we get to places where things are unexpected, our bodies just normally react with fight or flight. So even thinking about it psychologically, when you're faced with chaos, like that's the best way we can put it. Like when you're faced with so much chaos, your body just normally reacts by being ready for fight or flight. And when certain things happen in the market, traders will tend to react in the same way. So thinking about a black swan event, you have to remember that there is the unpredictability of the event, which is one of the things that will make it have extreme consequences in the market. So to start off, I think I can look at one of the black swans that we had recently. I think I can start with the one that we had in September of 2019. I think it was September of 2019. I was personally trading, so I faced that one. It was September 2019, I think. September, August 2019. And it was during the weekend. Saudi Aramco, which is one of the biggest oil producers, was attacked by Iran. Was it Iran? Yeah, Iran attacked Saudi Aramco, and they were not able to produce oil normally like they will be able to produce, and it happened over the weekend. I remember on Monday when markets opened, for me, markets opened about 20 points higher. So I think I was trading oil when it was around $45 a barrel, 45, 48, and it opened at $65 a barrel, and I lost 50% of my account instantly. Because what happens if you have a position and you have a big gap in the market, that gap risk, what normally happens is your stop loss will just be moved to where the market will open. So it won't pick your stop where you placed it. So if you had your stop, let's say at 50 and you were shorting at 48, it won't pick it at 50. Instead, it will extrapolate all the way to 65. So at $65 a barrel was where markets opened, and I lost 50% of my account. And that experience has forever stuck with me. And I think it's very important to think hard about how you can cover some of those risks. So one of the things that I personally resolved to do, or to try as much as possible to do, was to avoid having weekend risk, which is avoid holding trades during the weekend. But at the same time, I find myself sometimes having to hold trades over the weekend. But another thing that I've also learned is trading small sizes. So in my world of trading, I don't think at any point in my career I will ever exceed 2% risk on a particular position. I think it's very important to think about the longevity of your career rather than producing outstanding returns over an year. Because if you look at, like I was reading this book called The Psychology of Money, and it's a simple book but has some profound insights. And one of the insights that was there was the value of time. If you're going to, let's say, make a 25% return over a 30-year career, and someone else makes 100% but over a 5-year period, then you're definitely going to be wealthier than this person. Why? Because of the factor of time. So if you're going to trade markets, if you're going to be a trader and you're thinking about how you're going to trade, let's say from, like me, I'm just 25 now, 26. So if I'm going to trade, let's say for the next 30, 40 years, then I really have to think about how I'm going to cover some of these risks, because eventually they will happen. And one of the ways to do that is to trade at a very small size, which means for me having my risk tailored to less than 2% on any individual trade. I don't think you should expose more than that on any individual trade, because the consequences of that could be quite severe if certain things happen in the market. And I think we've seen cases where people have lost significant chunks of their account due to not being able to protect themselves from some of those downside risks. So I think that's where I can start.
Cool. So, my side, I'll talk about one event that was also severe that caught the market unexpected. Most of you know about this story, and maybe some of you may have not, but it's an important, especially if you're a trader, if you're into the markets, you should have known about this event. And it was when September 11th, 2001. It was not an easy day for the US stock markets and the world as well, because there was a terrorist attack on the Global Trade Center. I'm not sure of the name.
World Trade
World Trade Center, yeah. When the first plane came and hit the Northern Tower, and unexpectedly it was a terrorist attack, and a few minutes later we saw the second plane coming to hit the second tower, the South Tower. Actually, that day I think there were I think how many? There were about 4 attacks.
There were 3,
There were
but
3.
4 were planned. So 3 happened.
One
One
failed.
yeah.
Because if you read the history and check, the other one, what was the other one? Pentagon.
Pentagon.
Yeah.
We had Pentagon and the 2 World Trade Centers.
Exactly. So it's a good. You should go check it out and see what happened on that day. It was a very well orchestrated, planned attack that the terrorists had planned, and they hit those. They were attacking the US, and on that day, the stock market was actually down a big percentage, and also a few minutes later they had to close it down. And I think I was reading somewhere to saying I think it was the 3rd time the New York Stock Exchange had that prolonged closure for the day, because like Kenna said, it was very, very unexpected. Even the people who are trading didn't expect it. If you've watched Billions, the series, you'll actually get to see that Bob Axelrod starting out. That's how he made his fortune, yeah? Mm-hmm. It was during the 9/11. So when such events occur, there's opportunity to make money, and there's also a lot of opportunity to lose money as well. As you've heard, Ken lost 50%, and that's just Ken. The people who enter into even not loans, debt, bankruptcy, and you're in debt because it's unexpected. You had a position like the one Ken was saying. I remember that day markets all of a sudden opened. It was a gap.
Yeah, it was a gap.
It was a gap open. It was gap up, yeah.
Yeah, gap up.
And you are short.
Yeah, I was short, so markets opened.
And your stop was somewhere here. Then the market opened.
Market just jumped about 20% higher.
Exactly. And for those who do not know, if you get such gap openings over the weekend or something, it won't take you out at your stop loss. It'll take you out at wherever it opened.
Yeah.
So if it was way higher, if your stop loss was at 1%, as Ken is saying, it opened at 20% higher, you're down that percentage, you're down 20%. So this is very important, especially when you're growing your capital to become very big. We were following, I remember us following some people, some very good traders, like the one, what's his name, Taras? The one we used to follow, and then he blew his account with 201 trade.
Anthony
wins, yeah, exactly. So it wasn't really a black swan or anything. I don't know what happened, but such things can get you. And this person was trading about $10 million, yeah?
Yep.
$10 million successful for
over 5 years.
5 years track record. He had no losing month, yeah?
Yeah, no losing year.
No losing year, no losing month. Then all of a sudden, just 1 month, zero, okay?
99% gone.
99% gone. After a track, he started, I remember, it was at what?
$5,000.
$5,000, and slowly accumulating money and growing all the way to 10 million, and then in one day all the way to zero. So this is what we're talking about. That's now a black swan event on your account.
Yeah.
You had not planned for 99%.
Exactly, not had planned for that. And Taras will tell you also his story and tell you about another trade that he had sometime soon. But yeah, so those are black swan events. They come very unexpected and they are very sharp. They happen so fast, and sometimes you see a very quick recovery, like what we saw in COVID. Markets come
recovery.
They crash all the way down in 1-2 days, then all of a sudden markets rebound. Okay, it's sort of like panic selling. Then people come back to rationality and say, okay, why were we doing that irrationality? And start buying back into the stocks, and very quick you see things starting to kick back. So it's very important to pay attention and look at those history, because, for example, if a black swan event happens, and right now, from what we learned from COVID, if markets crash that quick, there's normally cause and effect. Yeah. Markets crashed, Feds came in, lowered interest rates, pumped money into the economy. We had never experienced that, but it happened over and over again. Yeah? Where markets crash, these guys come in, pump money and such, is to help kickstart the economy back. So it's also an opportunity to make money. So you should look at history, understand what has happened so that you can prepare for what is to come. So 9/11 was one of those events that you should go and check more videos, more history, more documentaries. They've done a lot on that. And see, now with the perspective of the markets, look at how 9/11 came and how it affected markets, not just in US, but around the world, okay? So those are important things you should pay attention to, and that's where I can start.
Yeah, okay. For me personally, I'll give a story of mine, which happened in 2020 during COVID. So, of course, COVID came in, I think, January, February is when it started like picking up globally. And just a month prior, the year prior, 2020 December, no one, as we were closing the year, no one told me as we were closing the year, in Feb there's a lot of risks, like biological risks that can cause effects in the markets. No one knew about COVID is going to come. It was a surprise for everyone. Actually, I always teach this in my fundamental class. If you had invested in Dow Jones in 2016 until 2019 December, you'd have made about 56% return on your portfolio. So let's say you have 10 million shillings. That's about 5.6 million shillings in profit. Then in 4 weeks, all those profits were wiped out. See, in 4 weeks, after 3-4 years of gains, you lose all your profits in 4 weeks. You see, and it caused a lot of portfolio dipping. Our mentor Dalio lost about 15%. Because actually,
which is how much?
Of about 200 billion. That's about 30 billion.
$30 billion.
Just remembered what Peter Lynch said. Peter Lynch said, "You only lose
when you cut out, when you carve out."
Exactly. If you hold, you stay in.
You see, also there are some levels of risks that you can't hold in your portfolio.
True.
Markets are dipping. Markets dipped 38% from Feb to March. 38%, very, very quick drops. I think every day when you're coming to the office, there was a limit down. A limit down is basically markets open and they're down already more than 7%.
Yeah.
So the stock exchange basically just closes for the day to avoid the markets from dipping further. So I think almost every other week,
they have a rule. They close for 15 minutes.
15 minutes.
Then another 7.
Open.
If it falls another 7, they close now again.
Yeah, okay, yeah.
Another 15 minutes. Then it falls another 5%. That for the day.
Yeah, for the day. Exactly. So the first limit down was always happening. Almost every week there was a day markets would just drop more than 7% on open. So at that point, of course, these billionaires who are heavily invested in the stock markets were losing a very, very big chunk of their portfolio. And of course, it's investors' money. You have some risk limits. You have some risk parameters you have to face, and that is why sometimes in black swan events now you're forced to cut out on very, very big losses. Of course, if you are an investor in the stock markets, you know the direction is always on to the upside. Even the market recovered from the Great Depression, which was an 80% drop. So always the market would always go up, but no portfolio can withstand an 80% drop in the market, you see. So it becomes very, very difficult for you to be objective on your long-term targets in the stocks you're holding when markets are dropping very, very fast. And the reason markets are dropping is an uncertain reason. Not maybe because of interest rates. It's happening because there's a global lockdown. So at that point, airlines were down, movement was limited globally. And demand for oil was almost zero. So there was literally almost no demand for oil. That time I was trading oil at about $20, and it was the lowest price I had seen in oil. I think it tapped $18, which was the lowest level before it went to zero. So at 18, markets bounced off from 18. I was like, hey, this is a very, very good support level. Markets tapped, rejected 20. I think markets were now at about $23 a barrel. These are very, very discounted prices if you've been trading oil. Because when you are trading oil, for a big part when you're trading oil, you are trading oil between 50 and 60. Basically 40 and 65 Apple. So that was the ranges we were used to. So getting a $20 barrel oil was a very, very big bargain. But markets had not felt the bargain yet. So markets dropped further. So I think I had made some money first. I think I had made some money actually on oil. And that time also, there was that aspect in trading that when such big risks comes, there comes a lot of volatility. and volatility gives an opportunity to make money, but also it gives the opportunity to lose very, very big chunks of your money. Because I remember just during that period when the volatility was coming, I remember we were making money on gold, and I was also trying to make money on oil. So actually, I think that time is one of the times I had one of the biggest returns in my trading. I think about more than 300% return in a month. So I think I had about 350% return. That much
In 1 month.
Yeah, that much. Exactly. And this is just to show you the consequence of trading in a very, very volatile market. You can easily make money, but you can also easily lose money. So I had made money in gold, a lot of money in gold, but I lost all of it in oil. You see. So when oil came, I had closed my gold positions. I was up in very, very big profits. Then I entered oil market. So at oil market, I saw this is another killing I'm going to
Greatest
make.
discount.
Yes. So $20. I bought at about 23, expecting markets to even go to about 30, 35. I'm out. Then
That's a 30% increase.
exactly. And that time there was a lot of
50 actually.
a lot of geopolitical risks. If you remember, during COVID also, it was not just oil supply due to the constraints of movement. Sorry, it was also there was Russia and Saudi Arabia economic wars. These guys were beating up their chest on who can produce more oil, and they're trying to produce more oil when there's no demand for oil. So there was basically too much supply of oil. And that is also another reason that actually led, because it got to a point whereby now the reservoirs were full. And that is now whereby these other oil companies, Shell now, are being called to basically take oil for free. And that is what now made oil go to negative prices. So oil went to negative $34 eventually, before it bounced back the following day at $20 again, then crashed again to $10, then now went up. So these movements are movements that really, really no one was expecting. And even in as much as no one was expecting, they are moving in very, very big percentages. Oil moving from $20 to $10, that is a 50% loss. You see, from 20 to 0, 100% loss. So actually, oil lost 100% of its value. And that is how also I lost 100% of my account. So, because the thing I was holding basically lost value. You see?
This is true.
But looking at it, is oil really valueless? Like, does it lack value?
No.
No. It's just basically the irrationality
price
of the market. So markets can easily get irrational, and the drops in the markets can be very, very big. The same way, the other we've said, the 38% drop in stock markets. The next consequence was 100% rise again from that low. So also these big gains. I remember when we were now recovering from after they raised rates. I remember markets were about 18,000. No, sorry, when they lowered rates, markets were about $18,000. And I remember me and Ken were like, these markets will pull back to about 26,000, then drop again a very big percentage.
They moved all the way to 36,000.
$37,000.
Double.
So exactly. Even and I think you remember even very, very great investors like what is the name of this guy who was saying when the printer stops printing?
Leon Cooperman.
Yeah, Leon Cooperman. Even them, they were saying like, no, we are not believing these market prices. Exactly. And that time we made a lot of wealth. Well, a lot of wealth was created. Elon Musk, I remember Elon Musk from Tesla. Coming from, and I remember we had a debate with Ken that time, if Elon Musk will come to beat Mark Zuckerberg in terms of wealth. Mark Zuckerberg that time was at about 100 billion already. Yeah. Elon Musk was at 30.
20-something
actually, 25. And in 2 years, this guy came to amass $300 billion. See, so stock markets also did the unexpected. Basically, not a lot of people were expecting markets to rally that far.
And that's the argument now for trend following. For trend following, we're trying to say we don't know what will really happen. And you're going to keep on buying until the thing changes. That's the idea.
What's the name for the guy from Jesse Livermore? The trend follower.
Mr. Partridge.
Partridge. What does he say?
It's a bull market.
This is a bull market.
He's always...
but for me, I was not really... I had not formed my philosophy on how I look at markets for a very long time. And I am sure many people have actually not even come up with a clear philosophy. We only focus on strategies and this is my strategy, there's a philosophy. There's how you think about markets. Okay?
How markets work, exactly.
For me, one thing that I've concluded is that it's very hard to predict markets. It's almost impossible. Okay, but the markets can always tell you we are moving higher, and until that structure changes, keep on buying. So like there's one quote that Richard Dennis says, which is the idea behind a trend follower is this structure means up and this structure means up no more. The idea is to keep on just buying and buying and buying until this structure says up no more. Okay, as long as it's going up, then say it's going up too much. Okay, that's why Livermore said prices are never too high to begin buying, neither are they too low to begin selling. Okay, that's the argument for trend following. So we'll keep on buying until the tide changes, and you keep on selling until the tide changes.
That's the same thing we've seen with the dollar. That thing has been rising.
Exactly.
It's deep corrections and rises. All
Dips,
highs.
Exactly.
And now oil is at what since you last sold it to zero?
Oil is now at about
100.
Yeah,
100
it came down to about 110.
But it hit top of
7,
Top of about
125,
130, 129 up, yeah.
from zero.
Yep.
And you can imagine now, on the way down, he lost money. Okay, on the way up, he'd lose money if you're selling.
Yep.
But if you're a trend follower, on the way down, he'd make money all the way to zero. And on the way up, when he realized the tide had changed, he'd make money all the way to 125. So when I actually teach my students, that's how I introduce them to trend following. I tell them it's a simple way of thinking about markets. Whatever goes up stays up. I know you've been told buy low, sell high. No, here I'm telling you what goes high. That's exactly. That's why I come back to again what I remember when I told you about cryptos. I told you buy them,
The strong,
and then you sell the
weak.
exactly. While when you're doing the opposite, is buying low and selling
High.
I'm doing the opposite. I'm buying high and selling low.
Low.
So whatever is high will keep on moving higher, and whatever is low will keep on moving lower. It's counterintuitive to how you may think you should trade, but
That's how markets work.
that's how markets work. Exactly. Very good point. So pole lawi nimekuingilia kidogo tu.
Yeah, I think that was my line of thought. So about COVID, that was it was a black swan event and led to a lot of now unexpected events happening. Like we also didn't expect Feds to keep rates at zero for 2 years. Maybe we thought the moment unemployment comes down, like the moment unemployment starts showing signs of moving down, maybe they'll start maybe raising rates. But they did QE for almost a year and a half. They lowered rates for strictly 2 years. So there was a lot of pumping of money. So all this was not really not expected, and that again now brings a lot of people now into that irrational exuberance. So some people now are okay. I think now this market now they get fooled into the party, but the party will end somewhere. So guys are now guys are still not believing maybe stocks will go down now. You see. So the fact that now you've been making so much money on something that was not really expected by a lot of investors, because right now I'm not so sure, but I'm almost certain a lot of investors now who are now waiting for the markets to recorrect to maybe to normality. Prices whereby now maybe things were not overpriced or overvalued, stocks not becoming too overpriced, creating a lot of billionaires very, very fast. Of course, now the smart money people are now thinking the opposite, expecting markets to go down, but there are also people who are now stuck now on markets can't go down. You see, we can't get into a recession. Bitcoin can't go to 5,000. Who said?
Exactly.
Oil went
Who
to
said?
zero. So all these things basically is
Even worse, go back to 100. Can happen.
Anything can happen in the markets, and now that is all about again like black swan risk. I think also the fact that we know some things can happen, yes, but we don't know to the extent of how much they can happen.
The magnitude
of how much they can happen. Because right now, yes, we know stocks will fall.
How far?
You don't know.
We don't know. We know cryptos maybe might fall. How far?
We don't know.
We don't know. Exactly. And all those things are still, you can't really predict certainly that this market will come to this price.
Exactly.
And now that is why trading is very, very difficult in terms of like, you're always dealing with uncertainty. Nothing about your career is very, very certain. You're not certain if because when we were reading the 13F filings, almost I think 15 hedge funds because they may file for bankruptcy.
Closed.
Yeah, closed.
And you've seen now the ones that have filed for bankruptcy.
How much?
this big one, Tiger.
Tiger.
He had about,
Melvin.
Yeah.
he had about
Melvin Capital.
Yeah.
and remember Melvin Capital
And-
had a problem ile time ya this GameStop. They were short.
They were betting against
the Reddit people
the
came.
Robin Hooders.
And that's the funny thing. I honestly find it very, very funny in that I normally hear retailers saying, institutions like these institutions do inafunga.
Manze. True.
Also lose dough. They lose
lot.
money in the markets. A lot.
Markets, a lot.
Seriously.
Very few firms actually make
like-
money.
Tiger, that guy had about 125 billion.
No, Melvin.
No.
Melvin had 125.
No, it's Tiger.
Melvin
Tiger is
had,
the big one.
Melvin
Melvin had about 50 to 50 because I remember they're down 25.
percent.
50% to
They're
25
down
billion.
50%.
Yeah, that's
52 actually.
52. That's Tiger. Tiger the ones with the 100 billion.
Mm-hmm.
They're down 52%. Imagine.
60 billion.
Gone.
Wiped out.
It's tough. So if you guys blow accounts, don't think it's just you.
Like you can't believe.
Even the
this
big
game
guys,
is tough,
the
man.
big guys at the
This
top are
game is
losing
tough,
billions.
man.
That guy is in, and that's why, and always teach my students, because when I'm teaching them about leverage, us guys who go down, we play with leverage like it's nonsense.
Exactly.
Those guys up there can't play the leverage.
Like that.
The average leverage because then 1:1 to Apple. You
If
can't.
you should
1:2 is too high for them.
Exactly.
They can't borrow
Bypass.
double or use double the money because you have 100 billion. You're trying to use leverage. Okay, lose because it's tough.
Exactly.
It's tough.
And you can also tell them about the story of long-term capital management.
Mhm.
That was one of the biggest
During the
firms.
2008 financial crisis.
No, it happened in 2000.
Oh, 2000.
LTCM.
2000.
Well, TCM,
yeah.
yeah, 2000, yeah.
It had
This was what Kina Solomon.
the
Yeah,
best
Solomon and Lehman.
Nobel mines sitting on their boats. These are Nobel mines. People who have won prizes. Okay,
Yeah.
they're running a hedge fund, and they closed down, and the Feds had to pump in money to prevent a financial crisis from taking place. Why? They took so much leverage.
Mm.
If you want to understand their story, you can read a book called The Smartest Guys in the Room. I think the collapse of that company, and you'll see how just being too leveraged and failing to understand simple risk management principles. You know, if you look at works of like Howard Marks, Warren Buffett, Ray Dalio, these people have emphasized how risk is crucial for a trader. I feel like you're saying, if you understand trading and investment, there's how markets work, and then there's risk. These two things, and then there's human behavior.
Yep.
Those are the three things you should really understand if you're going to be trading for long.
Risk, psychology, and the market.
Exactly. Human behavior. Just don't even call it psychology. Just say human behavior. That's one thing. The component of risk. That's another thing. And then there's how markets work.
Yep.
If you understand these three things deeply, you stand a chance of making money. You stand a chance. Okay? But the fact that you don't understand these subjects deeply make it very, very difficult for you to sustain a long-term career in the market.
And this is what I was telling my friend yesterday in the office who came to visit, saying how long, if how many modules or how many classes do I need to take so that I can start trading live and become profitable? And I might just told her, hey, it's going to take years. Like you're saying, because look, you have to understand human psychology. So you're going to study that. Then you come out and study risk. If you go to Taras's class, how many types of risks are there?
15. Some that we have not mentioned.
Exactly. By the time you read that, you become aware, then understand it and put it into action. After talk up, then go now understand the markets. Hey,
You've
my friend,
spent
then
some time.
now take that's knowledge now. Now gather it, understand it.
Synthesize it and come up with now principles.
Then now become wise.
Exactly.
Hey, my
Takes you
friend,
time.
it's going to take years.
Exactly. And that's why we don't say that it's going to take you. I also feel like many people don't understand when we say it takes years. We don't say it will take you years to probably make your first trade or to start making money in the market. No. What you're saying is
You're reminding me of that person on social media. There was a video we posted on TikTok whereby I was saying basically trading takes time. Like it can take you 2, 3, 4 years to learn how to trade.
That guy said,
This guy must have been a very slow learner.
Someone commented on our story.
So it thinks basically like I didn't understand like,
exactly. No.
what I was reading.
No, candlesticks.
I didn't understand myself.
Candlesticks you'll understand. 1% risk you'll understand even in a month. But for you to fully grasp what you're really doing, to understand what trading is and what it takes
time.
to really be able to come up with a philosophy. This is how I look at markets.
To even be in the markets long enough to face black swans
Exactly.
and survive and come back.
and come back.
Hey.
Those
Understand
things,
your risk appetite.
risk appetite, risk tolerance.
Moderate
to
maximum.
Exactly. Those things will take you time.
Time.
You'll not form a career out of trading by just being in the markets for a week or a
By
month
reading.
or by reading for. You'll have to read. You'll have to experience. You'll have to trade yourself. And then you combine all these experiences, and then you can now get to a point where you have now to develop those gut feels of even markets, how they work. Like you can just say here there's risk, here there's no risk. Like you can take trades, you can diversify, you can form portfolios. But it will take you time, man. It won't. Don't fike hapa ijakuwa just a year or two. It takes someone time for you to just gather up that knowledge and process it and come up with something concrete.
Yep.
So one of the ways I think to just add on to the topic as we sum up, one of the ways we can talk about ways now to prevent black swans. We've talked about and there are very many others. We've just talked about COVID, the one that happened in 9111. You can look at others. Some other examples that you can look at include the 1970s oil shock. That was when Israel was in war with Iran and the US didn't have any oil because Iran refused to supply oil to the US. So you can look at the oil shock. You learn a lot from that also. You can look at the flash crash. You learn a lot from that. There was a flash crash. Flash
2010
crash
flash
which happened in 2010.
Down for 1987, was it?
Exactly.
The market was down
22% in a single day.
Paperstone is an award-winning online global forex and CFD broker. It offers unparalleled service, exceptional pricing, and quick execution speed.
I think that's important to put in a single day. That was in 1987. So there are very many others, which if you just take your time to look at markets, you'll gather up enough knowledge to see there are some events which will happen over your career, which will send markets in some places which you don't expect. And expecting the unexpected is a better way than not being ready for the unexpected. So if you factor in on your trading plan, plan for the unexpected because it will happen from time to time. Make sure it doesn't put you, if you lose, let's say 10-15% of your account, coming back is quite easy.
Yeah.
If that's the worst drawdown you'll ever experience in your career, you're an outstanding trader. But even if you produce 100-200% return, but over your career you experience 60-70% drawdowns, I personally don't think you're a good trader because if you had 200% and at some point you lose 70% of that money, you're as well as you're just an average person. What you're good at is taking big risks. You're not actually even good at trading consistently. Because for me, a good trader is someone who can consistently make money for long.
If you have an account, then you lose 70%. Then now your account is at 30%, and you make 100% return on the 30. You're not even back to break even.
You're not back to break even.
You need to make more than 200%.
You need to make more than 200 to break even.
To just go back to where the 100% started.
Exactly. That's why you should understand risk.
True.
If you understand that,
if you lose 90%, you need 900%
to go back to break even. 900% return.
You got one of the greatest return, but you didn't eat a shilling.
So that's precisely the point. As a trader, if you understand that now, you know that your job is to protect the downside.
Yep.
Protect that downside at all costs.
Yep. And sorry to interrupt. Also we've mentioned black swans. People should not also fear the unexpected happening in the markets. Not that, of course, most times the masses will lose money.
Yeah.
But there are those people who make a bank,
Fortunes.
a fortune.
Yeah.
when
And those are the
markets
best times to make a
those are
fortune.
like the best
also.
times to make a
The
fortune.
time for oil. See, those guys
Yes,
who
me
boys.
when I
made
lost my
600.
oil, the Sussex boys
They made over 600
over
million.
$600 million in a couple of days.
Yeah.
Jesse Livermore, when he was trading, actually he was making money on crashes. 1907 crash,
1929.
1929 crash.
Good dough.
Bill Ackman
Bill
made 2
Ackman.
billion in 2020. COVID. So
Nani, the man who broke the bank, $1 billion. It was during that time of
Soros.
the pound. Nani. Yeah. So a lot of people also can make a lot of money also
Paul
during.
Tudor Jones, 1987, made a fortune. So
True. Also, a lot of traders made a fortune. Also, the .com crash.
.com crash.
Yeah. When some banks were dying into it, some traders were banking.
The Ray Dalio is one of
Ray
them.
Dalio
He
made a lot of
one
money
the
during that
best
time because
returns,
he
period.
predicted that event.
Then one thing people can go watch is to watch The Big Shot.
Yeah, the Big Shot also.
Watch The Big Shot and see how people are selling the market
Yeah.
and holding into it as it was still moving up. It's a good movie to watch for traders.
Yeah.
Yeah, so that was the point. Go on. I think now you are to say on the ways to at least
Prevent, yeah. So one of them for me is just in your plan, have a very good risk management plan and ensure you take less than 2% risk on any position. That way, even if you face a black swan where markets move 20-30% against you, you find that your account only goes down 10-15%, so you can quickly come back. The second one that I'd say is diversify. These black swans will affect markets in different ways. For example, we know that when we face certain risks, the dollar is up, stocks are down, gold is up. So we know some trades which take place.
Yep.
So always have positions which are diversified. Always trade markets which are diversified. Always create a portfolio whereby if certain things happen, your portfolio is still protected or is insured. For example, if you look like that, the all-weather fund that was created by Ray Dalio, that's what it's designed to do. It's designed to perform well in all market environments. Now, fortunately for you, if you're a trader, you can have the privilege of rotating around assets depending on how markets are moving. But at the same time, don't bet on timing markets. I think that's one thing we've told you for free. And we have done a very good job of pointing out to you that it's almost impossible to time markets correctly always.
That's why speculation is hard.
Very, very hard.
I was looking at the quote we always say about Bernard Baruch. Says, let me just quote it.
So timing is one of the things you should give up. Like we don't time markets. I think the three of us don't time markets. What we do is we trade a specific pattern. So once a pattern is presentable, you just trade it. But you don't say, this thing is going to this price. You just don't do that. You can't time markets. It's impossible. Come up with a different strategy of trading. Come up with a different philosophy of trading. But timing markets is not one of them. And I think the quote Lau is going to read will help you understand why timing is almost impossible, especially if you extrapolate it in the long run. You can time one trade, but timing 1,000 trades, my friend,
difficult.
It's very, very difficult. So those are the two ways that I'd say you can prevent yourself from black swan risks. And I think I can stop there on my end.
Okay, I think before I do that, I think I can say also just maybe one way you can try to, because we've mentioned diversification, which is key. I think that is the main way. Again, and diversifying across, like also diversifying depends on the level of trading you're at. There are some people diversifying across continents, some people diversifying across just asset classes. Some people are just maybe different currency pairs. So you should diversify a lot depending on the
strategies.
the strategies you're using.
Even diversifying risk.
Yeah, diversifying risk also.
Some you're heavy.
Yeah.
Or your portfolio.
Exactly. And now also we mentioned that leverage. Leverage is also another thing that makes a lot of people lose more money than they should lose in the event of a black swan.
And that's what makes people believe they can make a lot of money in short time.
Yeah, true. Because the few times they make that
It
money,
works against them in the opposite side also.
Yeah. So that is also maybe using good leverage. I always say 1:30 is a good leverage for a trader. So start.
As we use maximum of what 100. Yeah, we put 100. That's the account. Yeah. But while trading, when you're risking 1%, that means you're using what?
You're not basically using leverage.
You're not using leverage.
You're risking 1% of your initial money, of your $1,000, of your $10,000. You see?
So it's not leveraged.
It's not leveraged. Unless now you start maybe taking multiple trades. You see, maybe that is now maybe where you can sort of try to get into leverage side. But most times we are trading with less than 1:5 actually. Yeah. Apart from that, leverage. So always make sure your leverage is good, and also trade as if you don't actually have leverage. Also, another thing also, sorry, I can say is don't always be in the markets.
Very true.
Yeah. So
Cash is a position.
cash is a position. So these events will get you if you're in the markets.
Always.
If you're not out, if you're not in.
Actually, they bring the opportunities if you're out, because
exactly.
they push market to extremes
where now you can
opportunities
participate.
are now created.
Because now for me, if I wouldn't have bought at 20, ninge buy on the bounce back from 20. No?
Exactly.
But I mainly buy when we were still going down. So ninge ngoja kwanza ichape 0. Now so sapa. Yeah, exactly. We could easily be out of them. So another thing also is basically trading less with less leverage. But that thing is not as easy as we say. People people like the thrill of the market. Markets have some thrill, yeah, action, yeah. And that is why trading is very difficult. Maybe you can say one of the ways, then maybe I can read it.
Are you to read?
Okay.
Sign out.
So Bernard Baruch, one of very, very profound investors back in the 1800s, I think, said this. This was Ray Dalio quoting him. Bernard Baruch put it well when he said, if you are ready to give up everything else and study the whole history and background of the market and all principal companies whose stocks are on the board as carefully as a medical student studies anatomy, if you can do all that, and in addition, you have the cool nerves of a gambler, the sixth sense of a clairvoyant, and the courage of a lion, you have a ghost of a chance.
Ghost is the keyword.
Ghost of a chance. Kuna vitu mingi hapo you need.
Sixth sense of a clairvoyant,
cool nerves of a gambler,
and the work ethic of a medical student studying anatomy.
The courage of a lion.
The courage of a lion. Hiki tunahitaji vitu mingi bana.
Exactly.
It's tough.
Also, like when this, maybe you have been faced with a black swan risk. Ken was faced with it. He lost 50%. He still came back.
Yeah.
See,
the resilience.
A lot of people, hey, may lose. Dalio will lose 30 billion. He didn't chicken out. He just told his investors.
Dalio has lost even 100% at some point. He lost 1982. He lost everything. He had to borrow $4,000 from his father. You can imagine. This is someone who's trading north of $100 million, going back to and having the courage to come back.
Yep.
That is what it means. Or leave them. I think one thing I'm learning, the more I'm staying in markets, is trading is something that requires some specific traits in a person. Like it's not something that everyone can do.
Not everyone, of course.
Anyone can do it, but not everyone can do it. Okay?
True.
Yep.
Anyone can, but not everyone can. It's very, very important for people to understand. But again, we're not saying you should not try your luck.
Yeah.
Try your luck.
True.
Try your luck. We're not discouraging you from trying your luck. It could be interesting. I find it very, very interesting. One reason I'm still trading is it's very, very interesting. It's one of the biggest puzzles you can solve. It's one of the biggest, I think, one thing that I normally say is this is like a puzzle. You're solving problems. So if you love problem solving, if you love thinking about puzzles, if you can spend your time and your mental energy on and if these things are intellectually stimulating to you, you can really, really fall in love with trading. But if you're just there to make money, my friend, it will really become hectic for you, because it's quite something. And I really like it when students come to us, because often people will say, anytime I just come out of these classes, one thing I realize is trading is not what I was told or what I thought. And I always tell them, now you've learned the most important thing you should learn from this course: how to think about markets and how to think about trading. So with that said, I think we can stop there.
And for me, let me sign out. Me, what I'll say, if you want to mitigate those stuff, read.
Yeah, read history. Yeah, true.
Because I remember, like, when COVID hit, we're still learning. So we didn't know when markets are knocked off, this guy start pumping money, gold is a safe haven, dollar is going to rise,
Going to fall.
Understand how markets work.
Exactly. Just go read and see
Just
how
to read
history,
history,
how it's been performing. And it's always repetitive. There's nothing new under the sun. It's the same old things, just different
Nothing
markets.
new.
And actually, if you look at this, I think it's the same. Okay, it's a similar thing. If you look at what Ray Dalio is trying to do, Ray Dalio is actually doing like what he thinks to most people is it's a black swan. They don't expect the US will come to at a point give it the power to China. Hiyo anaona haita happen. See, the Ray Dalio is already planning for it. He's already knowing how he's shifting his money into the Chinese economy. So a lot of people, basically it's through reading. This guy has read 500 years of history.
Exactly.
Anajua this economy will rise and fall.
And he's compiled it in his book.
And these are the indicators that a certain economy is rising and falling. So me, I'm not guessing. You are refusing because you have not even read.
And I tell students that in my class.
Unexpected.
When you're looking at the economy, strength and how they are rising, you're looking at what the financial system, their military power,
Yeah, exactly.
Education.
exactly.
Productivity.
Of the, hey, my friends, it's deep, but it's fun.
Yeah,
it's
fun.
interesting. You
That's
get-
the point.
Because at the end of the day, you're learning finance, and finance is embedded in everything that you're going to do. Yeah. So that's it from me.
So you can stop it there.
We'll end it there.
Yeah.
And as I keep saying, and as I've started saying, as I sign out, remember to stay woke, stay financially literate.
Thank you very much for watching Financial Hub's content on YouTube. For more forex analysis, financial education, podcasts, and exclusive content, be sure to subscribe.